bring in Mohamed El-Erian, the Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Mohamed, always great to see you.
Thank you for having me, Melissa.
You know, with the S&P close to 4,200, Mohamed, it feels like the stakes are even higher for there to be a deal on the debt ceiling and for there to be a deal before this X date, just because of the valuations that we are at right now.
I totally agree. First, the only people who benefit from this debt ceiling saga are the adversaries of the United States. We are sending a very negative signal about our ability to run our economy, let alone be an anchor for the rest of the world. And the market so far has actually dealt with it very well. There's three big uncertainties: the debt saga, whether the Fed is going to hike, pause, or skip at its next meeting, and of course, what's happening to credit. So I look at this market, and actually I'm very impressed by how stable it has been over the last month.
You know, it's interesting that you mentioned, you know, the beneficiaries or adversaries, and I sort of heard the same commentary from Lori Calvasino of RBC yesterday, who said that U.S. investors are pretty sanguine when it comes to the debt ceiling, the belief that there will be a deal in place, but international investors are much more worried. Is this going to be a permanent harm in terms of the perception of the U.S. markets, or is this just going to be, oh, you know, it happened in 2011, it happened in 2017, and this is just another time?
You know, if it was happening on its own, I would say it would be very transitory, to use that awful word. But it's not happening on its own. There's other things happening. You know, people still remember that the global financial crisis originated in the U.S. People still remember that the trade tariffs that went against international law originated in the U.S. in 2017. People still remember that we had a banking tremor not a few weeks ago. So it's starting to add up. And this is important because already certain countries are embarked on building little pipes around the dollar as the reserve currency, China being the lead example of that. So we've got to be careful. We must not give the rest of the world one excuse after the other to try to de-risk from the U.S.
So there are a couple of ways of looking at the S&P 500 and how far it's come and how well it's held up. One way is to say, you know what, it's stronger and more resilient than we think. Or another way to look at it is that we are much more vulnerable because of the heights we are at right now, because of the concentration of the gains in the large caps at this point. What's your view of where we are?
I mean, you're absolutely right. I guess even more so because the S&P has been anchored by what I call all-weather names. Tech in particular, that is seen as doing well, that is seen to benefit from the AI theme, and that is seen to be able to generate revenues almost regardless of what's happening in the broader economy. So you have a situation where you've had a few names anchor the market as a whole, and then people are waiting. So this is what I call an unstable equilibrium. It's going to go one way or the other. Hopefully, the S&P will go higher because these things are going to resolve to the positive side. But it is uncertain. We are fairly priced for what we don't know, and we just need to figure out when are we going to find out, including the Fed. The Fed is going to play a very critical role here.
Well, fairly priced. I mean, I actually thought, Mohamed, you were going to say we are overpriced. So it's surprising to me that you said fairly priced. Why do you think we are fairly priced on the S&P?
So I've said for the last 6 weeks on this show, we are fairly priced. And I have been consistent in that view. Why? Because there's a lot of good things happening in the U.S. economy. The labor market remains strong. There's a lot of entrepreneurial activities going on. There is reason to be positive about productivity gains. So if we can just stop shooting ourselves in the foot, there is a runway for a bumpy journey to a better destination. We just have to stop shooting ourselves in the foot.
So good news is good news, Mohamed, finally, in the markets. When it comes to Fed rate hikes, though, I mean, are we going to be fairly priced if 2 more hikes come down the pike, as James Bullard is saying, or are we going to be fairly priced if it's 1 hike, but also the indication that there could be more to come? Or do we need to see a pause, a full stop pause, in order to say that we are fairly priced?
So of the 3 things I mentioned that are uncertain, the debt ceiling, what the Fed is going to do next, and what's going to happen to credit, to the economy, it is the Fed that's the most difficult to resolve. This is a Fed that has been inconsistent. It has made mistakes in its analysis, in its forecast, in its communication, in supervision. And it's very hard to predict. So, Melissa, I don't know what the answer is to that question because I don't think the Fed itself knows what it is.